Disclaimer: this is educational and informative investment content only, not financial advice.
If you're into dividends, you've probably seen those comments roasting dividend investors. Dividends aren't free money, they just come out of the stock price. Companies paying dividends have zero growth left. Why bother? Just sell shares when you need cash. Growth stocks will crush dividend value plays long term anyway. Sound familiar? Those hot takes sound smart, but they're missing the bigger bone. Today, we're burying those myths once and for all. We'll break down the real math behind dividends, why flexibility matters more than pure math, how dividend payers can actually deliver steadier wins with real examples, and why smart investors mix growth and dividends instead of picking sides. By the end, you'll see why dividend investing isn't just for retirees. It's a Paw-some tool for building real wealth without losing sleep over wild market swings. Stick around, this one's going to change how you look at your portfolio. Let's dig in. All right, Pack, let's chew on the first big bark people throw at dividend investors. Dividends aren't free money, they just come right out of the stock price. They're not totally wrong, but they're missing half the tail. Let's break down the math so we're all on the same leash. Picture this, a stock's trading at $100. On October 1st, the company announces killer earnings, $5 in excess cash per share. They decide to keep $1 for future business moves, we still own that as shareholders, and pay out the other $4 as a dividend to folks who own the stock by a certain date. Fast forward, ex-dividend date is October 9th. That means you gotta buy by end of October 8th to get the payout. Settlements take 2 to 3 days, classic market bureaucracy. On October 8th, the stock might actually trade around $105. Why? Market's pricing in future earnings worth roughly $100, plus that $1 retained earnings we all share, plus the $4 dividend coming straight to you. Then, bam, October 9th, ex-dividend day. New buyers don't get the dividend, so why pay extra for it? Stock drops roughly by the dividend amount. It opens around $101. Future earnings $100, plus that $1 retained still in the company. So yeah, the price drops by about the dividend. It's not free money. It's earnings the company generated and is handing back to shareholders instead of keeping it all inside. But here's where the anti-dividend crowd stops wagging their tails too soon. The real difference, who gets to decide what happens with that slice of profits? With Company A, the dividend payer, they give you $4 cash per share. You choose, spend it if you need income, reinvest somewhere else that looks tastier, or buy more shares of the same company because you believe in their bona fide plan. Sure, Uncle Sam takes a tax bite on that dividend. That's the price of having options. Flexibility costs a little. Now flip to Company B, no dividend. They keep the full $5 inside for growth. You still own a claim on it as a shareholder, but you're trusting management to allocate it wisely. They're making the call for you. Neither is automatically better, it's about control. Do you want the cash in your paw to decide, or trust the execs to reinvest it all? And hey, companies can do share buybacks too. That shrinks shares outstanding, boosts your ownership slice, often tax-free. But again, management's deciding when and at what price. Remember Meta in 2021? They dumped $40 billion into buybacks at $300 to $335, then watched the stock crater to $90 the next year. Oof. Or Dollar General buying high in the 200s only to see it dip below $110. Point is, nothing's always paw perfect. It depends on timing, valuation, and trust. So dividends aren't free lunch, but that drop isn't the full story. It's about who controls your slice of profits and why having that choice can be a game changer for real-life investors. Teaser. But what if they say paying dividends means the company ran out of growth ideas? Stick around. We're about to dig up why that's another half-truth. Quick pause. If you're tired of hearing dividend hate in the comments, smash that like button right now. It helps bury the myths faster. Okay, Pack, next myth coming in hot. If a company pays dividends, they've run out of good growth ideas. They're just handing cash back because they can't reinvest it better. Growth fans love this one. Sounds logical. If they're mature enough to pay out, no more big bets ahead, right? Slower growth, lower returns forever. But investing isn't in a vacuum. Things aren't equal. Companies evolve, markets shift, and no growth ideas ignores real proof that steady cash generators can deliver surprisingly strong results. Take an extreme tail wagger, Peloton. Back in July 2021, stock screaming at $125 after insane growth hype, over 2x year over year. Everyone thought endless upside, no dividends, all reinvested into the future of fitness. Fast forward to now, early 2026, trading under $7. Brutal wipeout. Never turned consistent profits. Growth story crumbled. Not saying every growth stock is Peloton, obviously not. Google, Amazon, Berkshire Hathaway, legends at reinvesting profits, massive buybacks, zero dividends for years, explosive returns in many stretches. But even there, it depends on timing and where the company sits in its life cycle. Check this recent 5-year total return snapshot, adjusting for latest data. Google often leads the pack, but dividend payers like McDonald's and Starbucks, they've held their own or beaten the no-dividend giants in certain windows. McDonald's around 80+% total return, Starbucks similar, outpacing Amazon and Berkshire in stretches over the past 5 years. Why? Solid businesses churning consistent cash, reliable models, less wild speculation. When growth bets miss, hello, macro shifts, competition, the no more ideas crowd gets burned. Dividend payers show strength, stable cash flow, proven ability to generate profits quarter after quarter. Growing dividends signal confidence in the business model, not exhaustion. It's another yardstick for reliability. Lower volatility? Often. Better sleep at night factor? Absolutely. Sure, pure growth can crush in bull runs, especially low-rate eras, but when rates rise, uncertainty hits, or hype fades, those consistent cash machines keep paying you while you wait. Bottom line, paying dividends doesn't mean zero growth ahead. It means maturity, discipline, and shareholder respect. Sometimes that's the smarter long-game play. Teaser, but what if they say you don't need dividends, just sell shares when you want cash? We're about to unleash why that's technically true, but practically risky for real-life investors. Quick bark, if these myths are hitting home, or if you've been anti-dividend, drop a "who's right" in the comments. Your take fuels the pack.
Next up, hack. This one's sneaky. You don't even need dividends. Just sell some shares whenever you want cash. Easy. Technically, totally true. If your portfolio's growing nicely overall, you can liquidate bits as needed. Works on paper. But here's the tail twist for real-life investors. It forces you into market timing. You decide exactly when to sell. Stock's down 20% that month? You sell more shares to get the same cash, shrinking your future compounding. Up big? You might hesitate, miss the income, or pay higher taxes on gains. Volatility bites hard. Prices swing wildly based on news, rates, sentiment. Your cash flow becomes unpredictable. How many shares do you sell? At what price? In a down market, it can feel like eating your seed corn. Dividend stocks flip the script. Reliable payers, especially consistent growers, deliver cash every quarter. No guessing the market mood, no forced sales at bad times. You plan ahead. This quarter's dividend covers X bill. Growing payouts? Your income stream rises over time, even if prices dip temporarily. That's huge for mindset. You feel like a true business owner. Own Starbucks? You're part owner of coffee shops nationwide. They pay you your slice of profits in cash. No need to sell your stake to get income. Same with energy plays like Valero or consumer staples. Quarterly checks arrive regardless of daily price noise. Selling shares adds variability you must manage. Taxes on gains versus potentially qualified dividend rates. Emotional drag of watching your position shrink. It's a different temperament. Not saying selling's wrong. If it fits your style, go for it. But for many, especially building passive income or nearing retirement, dividends reduce stress. Steady cash flow complements income needs without depending on a perfect sell timing. Psychology deep dive. Markets test patience. Wild swings trigger fear or greed. Recent studies show around 66% of investors admit to impulsive, emotional decisions they later regretted, higher among younger folks chasing hype. Dividend income acts like an anchor. Even in a crash, your payout keeps growing or holds steady. Less panic selling, more staying power. It's not about max returns every time. It's about sustainable wealth that matches your life goals and personality. Teaser? But what about the big one? Over the long term, growth stocks always beat value dividend plays. We're digging into index data next. Spoiler, it's not as one-sided as you think. Quick paw raise. Ever sold shares at the wrong time or love the reliability of dividends? Comment below. Your stories help the whole pack.
Last big myth, pack. Over the long haul, growth stocks crush dividend-paying value stocks, no contest. We've touched on individual picks, it's super company dependent, but let's zoom out to indexes for the fair fight. Using Vanguard ETFs as proxies, great data back to 2007, VUG, pure growth, VIG, dividend appreciation, companies raising payouts consistently, and VYM, high dividend yield, over roughly 25 years, 2007 to late 2025 data, growth, VUG, delivered strong annualized returns, around 11–12% compound in many long views, boosted by low-rate eras favoring tech and speculation. Dividend appreciation, VIG, clocked in closer to 9.5–10.3% annualized. High yield, VYM, a bit lower, around 8–9%. Growth wins on raw numbers in that stretch, especially post-2008 zero-rate world where big bets paid off huge. But here's the chew. We don't live in a vacuum. Macro shifts matter. Low rates supercharged growth for years. Now, in 2026, rates normalizing, inflation tamed, potential for more cuts, dividend stocks often shine when bonds yield less and investors hunt reliable income. Recent vibes, dividend payers poised stronger in shifting environments. Steady cash flow draws folks fleeing low fixed income returns. No guarantee, but history shows rotation happens. More importantly, performance isn't just numbers, it's behavior. Growth stocks swing wildly. Meta example again. Buy at $166 5 years back, you rode drops to $53, down big early, spikes to $380, doubled, crash to $90, down 46% from peak, back to higher now. Easy on chart, brutal in real time, many bail at lows. Dividend growers? Price volatility exists, but growing payouts provide mental anchor. Income keeps rising, even in dips, less emotional selling. Studies show approximately 66% of investors make regretted impulsive moves, higher in younger groups chasing hype. Steady dividends reduce that panic factor. Key takeaway? We don't have to choose sides. Growth for long horizon compounding, great in retirement accounts, ignore swings. Dividends for reliable progress tracking, lower anxiety, income stream building. Mixing both? Often the Paw-some sweet spot. Growth pushes upside, dividends add ballast, mindset stability, real-life cash flexibility. It's not about who always wins, it's about what fits your goals, timeline, and temperament. Sustainable wealth beats max returns if it keeps you invested through storms. Teaser, wrapping it all up next, why dividends deserve a spot in smart 2026 portfolios. Quick tail wag? Team growth, team dividends, or happy mix? Drop your side in comments. Let's see what the pack thinks.
All right, pack, let's bury this one for good. Dividends aren't free money. They drop from the price, sure, but that drop hands you control over your slice of profits. Flexibility beats blind trust in management every time. Companies paying and growing dividends aren't out of ideas. They're showing maturity, cash strength, and reliability. Sometimes that beats wild growth bets that flame out. Selling shares works until volatility forces bad timing and emotional sells. Steady dividend cash flow? That's planning power, mental anchor, true owner mindset. And long-term, growth can edge out on paper in certain eras, but behavior wins real money. Mix both, growth for upside, dividends for stability and sanity. You don't have to pick a side. Build what fits your goals, your timeline, your temperament. That's how you stack real wealth in 2026 and beyond. If this cleared up the dividend drama for you, smash that like button. It helps the pack grow. Subscribe and hit the bell so you never miss a Paw-some tip. Drop in the comments, team growth, team dividends, or happy mix. What's one dividend stock you're loving right now? Share this with a friend getting roasted in the comments. Let's spread the truth. Thanks for hanging with your favorite finance pup. Keep building, keep stacking wins. See you in the next one.